Richard Duncan, The Dollar Crisis, Causes, Consequences, Cures. Delve into the fascinating world of The Dollar Crisis, Causes, Consequences, Cures by Richard Duncan, as we explore the collapse of the Bretton Woods system, the end of gold-backed US dollars, and their ensuing economic consequences. Discover how the absence of a limited reserve asset, such as gold, led to unchecked credit creation and massive worldwide inflation of asset bubbles. By examining case studies from Japan and Thailand to the United States, learn how these bubbles eventually burst, causing economic collapse and dire consequences for global trade. This book summary will provide you with valuable insights into the causes of the dollar crisis and the potential solutions that may help prevent future catastrophes.
The rise and fall of Bretton Woods. The Bretton Woods system established a gold-backed US dollar as the international currency and prevented credit creation, but President Nixon ended gold's convertibility, leading to economic problems such as asset bubbles. The modified gold standard worked well until the 1960s when deficit spending and foreign investments shrunk American reserves. Other countries held increasing dollar reserves, leading to asset inflation and the popping of bubbles. The system's downfall resulted in an unparalleled increase in credit worldwide, ultimately leading to economic bubbles pop. The dangers of economic bubbles. Economist Jacques Rueff accurately forecasted the collapse of Bretton Woods due to U.S. deficits. Rueff recognized that U.S. dollars were backing the credit system in France while simultaneously expanding the credit system in the U.S. Similarly, the inflow of capital into the U.S. caused the creation of credit and economic bubbles which led to the Great Depression in the 1920s and modern-day, new paradigm, bubbles. The Dow Jones Industrial Average grew by over 1,000% from 1983 to 2000 before the stock market crashed. Rueff's prediction emphasizes the importance of monitoring economic bubbles as they inevitably lead to catastrophic consequences when they explode. The hidden risks of the American bull market. The American economy has been fueled by credit for the past 20 years, with trade surplus countries investing in U.S. assets to maintain competitiveness. The U.S. debt-to-GDP ratio has grown to 290%, making it a risky investment. Asset-backed securities have been a major source of new debt, particularly subprime home equity loans. The U.S. will likely face a financial crisis, with a bailout being extremely costly. The looming deflation threat. Excessive credit creation and global overinvestment in capacity have led to excess production, falling prices, and declining profitability. The availability of low-cost labor has contributed to the current slump in the U.S. economy. Policymakers insist on liberalizing trade, while politically powerful sectors are protected. Currently, American consumers enjoy low prices, low interest rates, low borrowing costs, rising home prices, and rising stock prices. However, if Americans stop spending, demand will fall, and deflation may replace the current inflation. In the long term, the U.S. faces the prospect of a slump like the one Japan experienced. Neither Keynesian nor monetarist economic policies can solve the problems that lie in store. This bubble in the first place was caused by excessive credit expansion, and the world is awash in liquidity. Even with 0% interest rates, businesses can't earn enough return on investment. The impending global recession. The American economy is in a recession that will be as prolonged as the previous economic boom. American consumer spending, which has driven global economic expansion, will decline as they reduce their debt. This will cause dire consequences for exporting countries in Asia, Europe, and Latin America, which have relied on the U.S. market for trade. As a result, they will not only stop making progress but may even go backward. The popping of the American real estate bubble will signal the beginning of the second phase of the new paradigm recession. Reduction of the current account deficit will coincide or follow the collapse of that bubble. The account deficit will eventually bring down the dollar, and surpluses in exporting countries will cause their currencies to appreciate. Even a 50% appreciation of China's currency against the dollar might not be enough to make the US more competitive with China in export markets. Consequently, China, Japan, Asian exporters, Europe, and Mexico will suffer the consequences of the recession. Overcoming the global economic crisis. The U.S. Federal Reserve Bank's plan to print more money as a solution to the recession could lead to hyperinflation. The world is in an economic, social, and environmental crisis, and both the Keynesian and monetarist approaches fall short. Trade deficits in the U.S. have caused credit expansion worldwide, leading to overinvestment, excess capacity, asset bubbles, and deflation. A coordinated approach, enforcing balanced trade, and central management of the global monetary system are needed. To ensure continued global consumer demand, a global minimum wage should be considered. It's time for a united effort to overcome the global economic crisis.
As we conclude our examination of the dollar crisis, we learn that unchecked credit creation and the end of gold-backed US dollars have fueled overinvestment, excess capacity, and asset bubbles, which in turn led to economic collapse. Richard Duncan argues that traditional Keynesian and monetarist solutions are inadequate to tackle this crisis, emphasizing the need for a coordinated global approach, enforcement of balanced trade, and central management of the international monetary system. By considering the implementation of a global minimum wage and recognizing that economies are interconnected, we may be able to avert future catastrophes and foster economic stability. The lessons gleaned from this revealing book are essential for understanding the complexities of the dollar crisis and navigating the precarious road ahead.